What do you really know about your investments and your financial advisor? Gary Cinderbrandt, a veteran advisor and founder of Better Path Training, has spent decades helping both financial advisors and their clients get it right when it matters most. Gary pulls back the curtain on the advisory world to reveal the truths, the gaps, and the opportunities that most people never hear about, but absolutely should. It's about more than money. It's about legacy, trust, and making sure the people you care about are in the right hands. Welcome to If the Public Only Knew. Now here's your host, Gary Cinderbrandt.
Welcome back to If the Public Only Knew. April 21st, 2025. Another down day in the markets. Now, you can go on any channel on TV or read any article on the internet, and everyone's going to give you their opinion. And people are really good at explaining in times like this what happened. That's usually after it happens. Going all the way back to my times at Merrill Lynch and listening to countless analysts describe what they thought was going to occur going forward, there was one I came to respect, not because he was right all the time, but because when he was wrong, he would come back and explain why. That analyst's name was Robert Dahl, D-O-L-L. He's currently the chairman of Crossmark Advisor Solutions. Since he's no longer working for a big Wall Street firm, his opinions are his own. He's not working for a buy-side shop where he might be hesitant to come out and tell you what he really thinks. He puts it out there, he admits when he's wrong, and then he tries to do the best he can going forward. Reading his most recent report in combination with what we're seeing, I thought I'd take a few minutes and kind of pull apart in plain language what's actually happening. As you can see from the first part of this slide, I refer to this as the find out phase. That usually comes after the F around phase. We are now firmly in the find out phase. And unfortunately, I think we're just getting started within that phase. Let's talk about that a little bit. Think about where we were at the end of 2024. The economy, our domestic economy, was absolutely the envy of the world. We had job growth over 15 million jobs. We had the middle class earnings rising constantly. More minorities were employed than ever before. Was everything perfect? Hell no. When is it ever? But the reality is that all Trump had to do was sit there and basically play golf every day. It would have been a lot cheaper than what he's cost us so far or what he's likely to cost us going forward. But no, we had to go in and try some ideological play, which deep down, I always kind of think that every time he does this stuff, him and all his cronies are short the market. But hey, that's just me. So what happened? We had all this optimism at the beginning of the year. Market rallied because we thought it would be a business-friendly environment. Ruh-roh. So now we've got all these pro-growth initiatives, less regulations. We don't need to worry about, oh, and by the way, we're going to levy a sales tax of between $3,000 and $6,000 per year on every household in the United States, in the form of tariffs. Oh no, they say, tariffs bring money in. Yeah, they do, but the money comes out of the pocket of the U.S. consumer. Again, this is not a complicated concept, which is why I always go back to when these guys who are making policy are pulling this nonsense. I always go back to the fact that they're basically short everything they can possibly find, because that's the only logical reason, especially when we're being led by an individual that bankrupted 3 casinos. How do you do that? I give you $1. All you have to do in a bad situation is give me back 6 cents. But no, what'd you do with the other 94 cents? Poof, gone. So again, I think this guy's motivated by money and accolades, and that's it. Markets react in a hurry. Well, all sorts of reasons why. Yes, markets don't like uncertainty. Here's another one for you. If you're an investor and you don't live in the United States, why would you want to hold dollar assets? Wouldn't you start liquidating treasuries like the Japanese and the Chinese are doing? Rising interest rates cause all sorts of other problems. Probably get into that on another podcast. When we start to see that and there's wholesale selling, people essentially are going to follow the crowd. Now you've got confirmation bias and recency bias. It's going down. It's going to continue to go down. Market stability diminishes rapidly, crushing consumer confidence. Now, it's not all horrible. If you've been following a discipline and you've been rebalancing your portfolio away from uncertainty and towards a smoother ride, taking advantage of these outsized equity market returns we've had in the past several years, maybe you can ride this thing out. But I wouldn't sit around and wait for it to all come back. The Fed, which is a completely independent entity, as declared by Congress, is now under pressure. Just this morning, Trump is out on his Truth Social, doing whatever, basically calling Powell a loser, claiming there's no inflation. Oh, that's interesting. There's no inflation. Yet we have these tariffs that every economist on the planet says are inflationary. When Trump represents, many people say this, many people say that. Essentially, those many people are voices in his head. There's no one out there, with the exception of Peter Navarro, who I think is as ill-informed and as nuts as everybody else out there, stating that tariffs levied on goods coming into the United States, which have to be passed on to the U.S. consumer, are good for anybody. I'm not even getting into what's happening to the dollar, because the dollar is down somewhere between 8 and 15% against major currencies. What does that mean? The goods actually coming into the United States are more expensive immediately. How is that not inflationary? Not sure what this guy's looking at, but again, it's not what everyone else is seeing. Threatening the chairman of the Federal Reserve, who will stand firm, but threatening the chairman of the Federal Reserve and calling him a loser, how much stability does that introduce to the markets? And if you're a foreign investor or you're running a company domestically, how are you going to make decisions as to what you're going to do going forward? You know what you're going to do? You're going to stick your hands in your pockets. You're going to try and ride this out by hoarding as much assets and cash as you can. And you're going to hope for better days sooner rather than later. What does that lead to? Oh, I know. A recession, which I think we're already in, well into the second quarter. We'll see it when it comes this way. But essentially, Goldman Sachs, which was up plus 4% at the end of 24, worked its way all the way down to minus 3.8% first quarter, now says we're lucky if we have any growth whatsoever. Keep in mind, folks, this is a self-inflicted event. This did not have to happen, but to sit back and not react to it as an investor or an advisor, you're making a mistake. Rate cut demands. The administration is pushing for rate cuts. Let's see. We've got structural inflation being introduced by executive order, and now we're going to cut interest rates. Let's see. What would that do? Let me think about it. Steepen the yield curve. Yep, short rate would come down, but mortgage rates are based off of the 10-year Treasury. Powell can do all he wants. He doesn't impact the 10-year Treasury. That is impacted by supply and demand and the buyer's viewpoint as to where inflation will be going forward. As 10-year Treasury yields rise, mortgage rates go right with them, which slows down people buying homes, people building homes. But you can't build homes because you got to get lumber from out of the country. Oh, sorry, there's those tariffs again. Damn. Yep, rate cuts. Not going to happen anytime soon. I'd be stunned if we see a rate cut presently. Even if they ultimately cut, it's not going to stimulate all that much. All it's going to do is weaken the dollar further. Jerome Powell, right now, seems to be the only guy with his head screwed on straight. Maybe a few justices in the Supreme Court are starting to get it. But what we need to have happen is for 13 senators besides Murkowski on the Republican side of the aisle to walk into Donnie's office and say, enough is enough. Quit this nonsense. Appoint real people in your cabinet. Go play golf or you're done. I don't see another way out. God, the Wall Street Journal called for the guy's impeachment the other day. This is as of last week. I can't keep updating them all the time. Since Liberation Day, 50 basis point Treasury yield increase, probably as of today, 65 or 70. Why does that matter? Well, first of all, as foreign governments liquidate our debt, prices go down on bonds. Too much supply, yields go up. U.S. Treasury is in the market all the time. So what that means is debt that came due that they could have refinanced in a 10-year or a 30-year, let's say as far back as 4 months ago, they could have refinanced it at 3.5%. Well, now they may have to pay 4.25%, 75 basis points on hundreds of billions of dollars that we owe going forward. What does that do for us? Oh, I know, it balloons the deficit. You know what else balloons the deficits? Tax cuts for billionaires. Same thing. Again, I think it's all a grift. Mortgage rates above 7% automatically pushes home values down. Dollar versus the euro -7, dollar versus Swiss francs, again, down and down. Dollar denominated assets, not so good. Now, are foreign assets holding up better? They are, but on a relative basis. Because essentially, our markets are so intertwined. When things go down, they go down. Having all your money basically in growth U.S. assets, where all the money was made over the last 20 years, whenever there is a climactic event in the market, and that can last a week, a month, or it can last a year, the leadership that reemerges is never the same. Whatever got you here in the first place isn't going to see you through the other side. There's other things happening, and you have to pay attention. Bob Dahl calls this the end of the corporate golden era. I happen to agree with him. If you've been invested in U.S. stocks for the past 40 years, you did amazingly well. You did 2 or 3 standard deviations better, especially over the past 5 years or so, with the exception of 2022. You think this is going to continue? Probably not. earnings have probably peaked for domestic companies for an indefinite period of time. We live in a faith-based system. If we don't think tomorrow's better than today, we're not going to spend money in our pocket today thinking it's going to come back tomorrow. That impacts every segment of the economy. Dahl basically forecasts the price earnings multiple on S&P earnings to contract from 22.8 down to 20.5. And that's the contraction we're seeing now. For those math geniuses out there, that's a little less than 10%. Well, we're in correction territory already. So the market's going to be true to form and probably shove this thing way, way past where it should be. The problem is we've got this guy in Washington who I think basically is chasing more ideology and attention, thinking the world's lining up to kiss his ass to make deals. And we may see this thing absolutely slip into territory we haven't seen since the '08 meltdown. Bob Dahl, further corrections are likely. Yeah, I don't see how you get away from that. So what's the signal? What's the noise? Here's the noise. Daily price fluctuations. Guys, it's going to be a rough ride. And if you are not invested based on specific outcomes that you and your advisor, and I'm talking to UFAs, if you have not reforecast your cash flows and you haven't done that in some number of years, shame on you. I used to do it whenever my initial asset allocation got out of round by 10%. Starts at 50-50, goes to 45-55. I'll ride it out for a while. Goes to 68% equities and 32% bonds, which is where a 50-50 portfolio ended up after 5 years at the end of 2024. And you're still sitting there looking at it. Do your job. Would you put that money to work the same way today? No, you wouldn't. Good news is you made a lot of money the last 4 out of 5 years. Put it someplace where you know it's going to be there. Put it in CDs. Put it in short treasuries. For God's sake, don't buy bond funds. They don't come due. You don't know what they're going to pay. Rates go up. Your NAV goes down. Rates go down. Your yields fall. Now, interestingly enough, this is usually a time in periods of economic uncertainty when people flood money into treasuries, usually through bond funds. You know what they're doing now? They're getting the hell out. They're getting out because they're seeing their NAVs go to hell in a handbasket. By the way, most trailing returns on government bond funds, if you go in and look at how much did I put in, how much did I get out, my bet is that your overall administrative and sales charges are higher or more than you actually made. That's just me. So what don't you do? Well, political rhetoric is everywhere. Doom scrolling's become a national sport. Or I would say a way to nationally get depressed. Short-term reactions. Yeah, you see those in the market. Social media chatter. What's interesting here is even the people that supported this party going into the White House, let's start with Amazon. Let's go over to Google. Let's look at, Meta. Let's look at all these gazillionaires that thought everything was going to be great when Trump got in there. Go take a look at their stock price and compute how much money they lost in the past month. Number is a lot. Now, are they going to go poor and miss it? No, they're not. So let's not feel too badly for them. The people I feel badly for are the people that, as this basically evolves, are going to ditch the market as a long-term investment opportunity because their belief, and I think rightfully so at this point, is the game is rigged. And you can't just depend on what people say. You got to watch what people do. The counterpoint to that is this. There are great companies both in the United States and all over the world. The people running these companies, that built these companies, they don't become idiots when political uncertainty and insanity impacts the price that's there. Stay with quality. Stay with things you understand. Stay with things that pay dividends. The boring stuff. But don't sit there and hold out hope that things are going to change just because that's the way they were before. What do you watch? What are the policies that are going to get implemented? Not really sure. Entirely possible. We could see within a short period of time, Congress get the cojones to actually go in and pass a law which prohibits the administration through executive edict to basically serve the whims of the dear leader, prevents them from screwing around with these tariffs. That could unwind the trade war. My thinking is next to an impeachment of this idiot, I think the only thing we can hope for is we've got enough Republicans to get a veto-proof majority through Senate and take this power away from Trump. His Supreme Court is even fed up with him. Midnight ruling the other day, 7 in favor, 2 opposed. Let's guess. Oh, Alito and Thomas. You can't just grab people off the street without due process. There's a surprise. Why? Oh, I know. It's the Constitution. So what's next? Oh, I don't know. I was listening to Olbermann last night. He talks about the Declaration of the Insurrection Act. I get worked up with this shit. Now, the problem is they've done a pretty good job of closing off the border. So who's gonna claim is invading us? Hondurans? Where are they coming from? Good luck getting that through. So I wouldn't be surprised to see it, but I think there's a better even chance you're going to see the Senate and the House take the power of tariffs and by edict remove it from Trump's ability to issue executive orders. Central bank actions, the only thing keeping a lid on this thing right now is Powell. If Powell leaves or gets fired and they put some idiot in there, I would basically just buy gold, sit in cash, and stock up on fresh water because I don't know where that goes. Institutional capital flows, same thing. Foreign money's not coming here. Foreign money's going to get out of dollar assets as quickly as they can. As an FA, it's your job not to try and interpret all this noise and try and guess what's going to happen because essentially you're just looking at fog right now. And there's no way to know what's going to happen next. Take control of what you can. Work with your clients, not about what's going to happen, but about what they need to do. Make certain their assets are allocated in a way that makes absolutely sense. Don't get emotional. I used to get worked up and completely passionate about the outcome that I would fight for on behalf of my clients. And a lot of times, I had to make some pretty strong arguments with people to prevent them from hurting themselves. So I was cold and calculating as far as getting people to move in the right direction. I would not make an emotional decision on behalf of a client. That's not what I was hired to do. As an FA, you need to make certain your decisions are grounded in fact, math, long-term expectations, and rationalize them. Great, you made 15% on average the past 5 years. Think that's coming back? Think again. Again, we're in the find out phase. Do your analysis. Figure out what the cash needs to be for the future. Tie every investment to an outcome. Recalibrate. Take a look at your plans. Oh, and by the way, please, FAs, make sure you're not taxing your clients' equity returns 100% per year. I see that a lot still. Basically, it's the default in financial plans. Don't rerun the numbers. Do your jobs. Okay. Key takeaways. Talk to them. Talk to your clients. If you're not calling them and they're calling you, you're behind the curve. My attitude is you should have been calling them all along. You should have been rebalancing all along, but hey, that's just me. I get accused. Cinderbrand, you're early. You're right. Guilty. Early. Sorry. But you weren't wrong. Here's how I used to explain it. When I used to go to parties in college, what was my goal? I wanted to get there just as things were getting set up. I could watch people come in, be there when the band started playing, saw where the food was coming out. It was all good. When did I want to leave? Before the cops arrived. That's when I wanted to leave. Guess what? Cops are here. Party is breaking up. Make certain you put away as an FA for your clients to get where they need to go. And if you're an advisor and you're not rebalancing, you got to think about what you're doing. If you're an investor and now is the first time you're having a risk mitigation discussion with your financial advisor, you need a new advisor because that's the major job to do. It's not telling you what to do. It's telling you what not to do. Little mental exercise. Why don't you make believe that what you're sitting on right now is all cash? Everything. It's all cash. Forget taxes, forget costs. Would you put that money back to work today in the exact same investments you currently own, essentially all at a basis of what your cost is? And if the answer is no, what are you doing? With the exception of perhaps some tax treatment, one way or another, what are you doing? Those of you with really long-term gains, let's take a good example of a stock like NVIDIA. And we look at that stock and we see where that is right now. And that stock is NVDI, quote, NVDA. So, the stock's 95. All right. So I'll give you a real discussion that I had with a very, very good client, an FA, that basically I consult with on a regular basis. He had a client that invested in NVIDIA when NVIDIA was $2 a share. $2 a share, not bad. Now, at the end of last year, where was that stock? 138. Recommended to that FA, they advised the client to perhaps take some profits. FA said, no, I don't think they want to do that. They don't want to pay the tax, long-term capital gains, blah, blah. So 20% of 138, let's see. Low cost basis in the stock probably would have reduced that net sale price to about 115 after taxes. And where is NVIDIA today? Oh boy, 95. So yeah, let's not make decisions based on what the tax impact might be. So you didn't make 47 times your money, you only made 41. Put it someplace else so it's there when this thing turns back up at some point in the future. Remember, whatever led us up before it cracked is not leading us out. It's going to be something else. Prepare for turbulence. Have a plan in place. Set your asset allocation based on your outcome. Allocate every dollar you have to a specific goal and target. Again, as an investor, if you don't have an FA that's running those numbers for you and talking about how this comes out using very conservative approaches, find another financial advisor. You're not sure who to go to? I'm happy to help you figure it out if you're an investor. But don't just sit and stare. This thing is likely going to get worse before it gets better. Strap in. Investors, stay cool. Advisors, do your jobs. Thanks for listening. Talk to you again on the next cast.
Thanks for checking out If the Public Only Knew with Gary Cinderbrandt. If you found today's episode helpful, be sure to follow the show and share it with another advisor, investor, or friend. For more on Gary or to check out any links mentioned in the episode, head to the show notes. We'll see you next time.